All right, greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. All right, so today is Tuesday. It's June the 11th. I'm currently in a trade here. Let me just pull out my pointer. So as you can see here, I'm on the call side. I got 16 contracts. Got my short strike at 5,400. And my long strike at 54.05. So I sold this one and I bought this one. 16 contracts. And as you can see here, so I actually put this on yesterday at around 1:46 p.m. Eastern Standard Time. All right, so as you can see here, I mean, it's pretty much, unless something crazy happens, which I don't think is going to happen because we have the FOMC meeting tomorrow. We also have CPI, Consumer Price Index, tomorrow, so I don't think the market is going to do too much today with regard to going to the upside. So I think this is pretty much money in the bank. If we take a look at the chart real quick, so we can see, so the reason why I got into this yesterday was because the opening price on the SPX yesterday was 53.41. Let me just check that to make sure. So it was 53.41. Yeah. So as you guys know, if you've been watching my videos, I know I don't get in until the SPX makes what I consider a significant move to the upside or to the downside. So a significant move for me is 20 points above the opening price or 20 points below the opening price. So not the previous day's closing price, but the current day's opening price. Right, and so that didn't take place until around, and so this here is the price action from yesterday, right? So that move wasn't made until 1:49 p.m. So as you can see here, the high, if you look over here, right, I'm hovering over the candlestick on this 1 minute chart at 1:49. As you can see here, the high is 53.62. So it went 20 points above the yesterday's opening price at 1:49. Now I got into my trade at 1:46 because I was anticipating that that 20-point move was going to take place, and I wanted to get in. I wanted to try to time it as perfectly as possible, although you can never really time these things perfectly. But nonetheless, I got in at 1:46 with the thought that today is one day before the FOMC meeting, so that the market is not, market participants are not looking to, I think, and in my opinion, not looking to take the market any higher until after the FOMC meeting and also the CPI, right? So going on the call side yesterday for the expiration date today was a high probability trade for me, and is a high probability trade for me, right? So so that's the reason why I went on the call side. All right, and also if we look at what's going on right now, we can see, looking at the market internals with the volume up minus the volume down, we can see that the volume has significantly dropped. We can see that the advanced declining indicator is also to the downside. Although the tick, there seems to be some stocks that are ticking up on the New York Stock Exchange, but nonetheless, it's still in that very, very bearish or neutral territory, right, on the tick symbol or tick indicator. And then also, we got 10 out of the 11 sectors that determine how the S&P 500 actually moves, or the SPX moves. Everything is in red with the exception of XLK. Now, XLK has the largest impact or the largest influence on how the SPX moves, but nonetheless, as we can see here, it's barely in the green. And if we go into the XLK to look at the primary components of the XLK sector, we can see that, we got the big dog, Microsoft, is in red. And we also got, where's NVIDIA? Well, NVIDIA is just barely in the green. As you can see, it's oscillating between red and green. And then we also have Apple. Apple's up pretty strongly today. But nonetheless, the XLK sector overall uh, is go back to the 11 sectors. It's just barely in the green. So that being said, this is pretty much money in the bank. And again, waiting for that move, from my perspective and from my experience, because I always like to say that money is an abstract form of energy, and so as money comes in, whereas money goes out of the market, and it causes a 20-point move above or below the opening price, then for me, that's a cue to look to put on a trade, not to automatically jump into a trade, but to look to put on a trade. So hopefully this helps. All right, guys, I had to come back real quick to finish this off. And this is the epitome of what I'm talking about, right? So I mentioned that I got into this trade here. Let me just pull this up. So I'm actually on the call side, right? So I'm on the call side for today, but I actually put this trade on yesterday, right? But nonetheless, if I was looking to put on a trade today, then I actually would have put the trade on the put side. Why? Because this move here represents a 20-point move below the opening price. So the opening price today is 53.53, right? So 20 points below that, it's 53.33. So as you can see here, this candlestick dropped 20 points below the opening price. And so I would have been looking to get into a position, and obviously I'm looking to go further below this floor, right? Because this floor, as you can see, is right here. And this took place at 9:45, right? But there are some people who, they trade the 15-minute breakout or whatever, or there are some folks who just look at, the price action and just assume that because the price is dropping, that it makes sense to go on the call side, right? It makes sense to go on the call side and maybe go here at 50, put your short strike at 53.45, close to 53.50. But as you can see here, as it's dropping, boom, then it hits the floor and it bounces and it goes right back up. And this is the reason why I prefer, right, one, to wait for the 20-point move above or below. And then two, I'm always looking to trade in the direction in which that 20-point move was made. And so had I been looking to get into a trade today, I would be on the put side right now. And obviously, we can see what happened, right? It bounced and it went back up. Now, had I been on the call side, my position would have been threatened. And so I would have had to either close out the trade or roll the position until tomorrow's expiration, which you don't want to do because the FOMC meeting is tomorrow. Also, CPI is tomorrow, or into Thursday, which you don't want to do because PPI is coming out on Thursday. So again, it's always important from my perspective, now, however you guys trade, that's on you. If it works for you, continue to do it. But nonetheless, my thing is 20-point move below the opening price or above the opening price, and you want to trade in the direction in which that 20-point move was made. And in this case, my trade would have been put on the put side. So again, hope that helps.